Please join me in welcoming Mark.
Thanks. And just to clarify something, Lori, if I have AV or IT problems, today's code word is the same as yesterday. It's rat bastards. Okay, good. So, okay, so thank you, Peter. I thank for letting me come talk about analyst forecasts. It was several months ago I got an email from Peter, and it was announcing this conference and the fact it was in Georgia, so I was excited. I was ready to reply right away that I would attend. He named several of the sessions, and I was particularly interested in seeing what somebody had to say about this session called How do Analysts Forecast Earnings and What Do They Do with Forecasts. It was later in the email Peter said he was going to call me and suggest that maybe I would talk about this, and I said, well, I guess if nobody else knows anything about it, I can answer as well as anybody. So it's ironic that I'm here because when I started the PhD program, I'd come fresh out of 6 years with Arthur Andersen, and to me, I had a view of what accountants do, and I kept seeing all these people come through and present papers on analyst forecasts, and I was just irritated because they seemed to be tangential to what I considered accounting. Okay, and so if you had told me back then that 5 or 6 years after graduating, you'd be coming to a Georgia winery, that would have been funny. But then that I was going to come and I was going to speak on analyst forecasts, I would have laughed you out of the house because I was disgusted with the analyst forecast research before I knew anything about it. Recently, though, I sort of gravitated back towards that, what was Jeff's word yesterday, consternation about this literature. And I think it's not just me that's recently been questioning the analyst forecast research. And so I had several observations over the past several months. I was in Chicago presenting, and I heard several faculty say, every paper this semester has been on analyst forecasts. And it wasn't necessarily negative, but they weren't celebrating the fact either. I hear that Ron Dye had a top 10 list about a recent Emory conference, top 10 reasons he liked the conference, and number 1 was no analyst papers. And I saw a FARS discussion by the otherwise obsessively happy John Hand. And he started off his discussion by saying, this literature has become long in the tooth. And then it went down from there, and I think he concluded we needed creative destruction of this research area. And of course, I had a pleasurable 2-hour conversation with Jeff Barbanel a couple of weeks ago where he said, you've been given the topic that people hate more than anything. So with that, it's going to be exciting to start off. So if everybody else had a nice, simple topic to discuss, like earnings quality or valuation or forecasting earnings, but I guess Peter worried about me rambling on about a number of things, so he gave me a specific set of assignment questions, which are, how do analysts forecast earnings, and what do they do with these forecasts? Now, I've been in the profession long enough to know that when we see things like a conference theme, we don't necessarily have to stick to it, right? We can change it all we want. So I will pretend like my assigned topic was analyst forecasts, and I'll do that for a number of reasons. One, I think the answer to how do analysts forecast earnings and what do they do with these forecasts, based on the bulk of research evidence we have, we can't answer this question. Okay, and so, maybe if it was sunny, I would actually stick with the title Peter gave me because I could be done right now. Right? But if I say my topic's generally going to be on analyst forecasts, what do we know about analyst forecasts, and what are we doing with this whole literature? I'll be able to go for another 45 minutes or so. So as an agenda, what I'd like to do is sort of give you a framework on how I view the analyst function. Okay? And so it seems appropriate that if I'm going to give you some comments on what I think about the literature, I should tell you how I view the analyst job function. And then I'll try to quickly compartmentalize the literature into 3 general buckets and give you my view on how this literature has transitioned to the point today where I think the way research is being conducted is what's causing a lot of people to be cynical about the analyst forecast literature. Okay? And while I don't have a lot of answers or prescriptions to give you, hopefully some of the comments I'll mention along the way will stir some thought, and maybe you can bring them up in the question or insult section after Rick and Pat speak. And so I have 10 observations if you want to keep track of them, and you'll know how far I'm into my presentation as we go. First, a disclaimer. This is the slide I think Xiaojun wanted to have yesterday. He mentioned in the middle of his discussion. It's not a literature review. If I overlook something that you've done, it's because I don't have time. And I'll refer you to several articles in print that summarize the analyst research. Gavoli and Lakonishok and Brown have an early summary of this literature. And particularly interesting are the 4 commentaries on Larry's discussion by O'Hanlon, Thomas, Brown, and Zmijewski. I particularly like the discussion by Mark Zmijewski. Things he said back in 1993 are still applicable today. And when you see a quote by Mark, that'll be my last slide. Catherine disavows her commentary as a review, but a lot of the comments she made in that Accounting Horizons write-up are, again, applicable today. And I'll mention several of those. And recently, Ramnath, Rock, and Shane have a review updating us through 2006. And it's not necessarily a working paper so much as a tome, because it's 110 pages long. So let's go back real quick. Why did we study earnings forecasts in the first place, or analysts? Well, just like we talked about yesterday, the key in valuation research is getting a measure of expectations. Okay, and so we had a long literature looking at time series models, and it eventually wound up that we concluded analyst forecasts are a better substitute for time series models. Okay? And so a question we ought to ask at this point is, why do we still study analyst forecasts? And so here are 3 cynical responses. The data is really easy to get, it's widely available, it's cheap, and it's easy to use. That's not a good motivation for studying analyst data, but I have to think that there is a shadow effect of the widespread data availability of analyst forecast data. As academics, we love looking at distributions. And with analyst forecast data, we have all kinds of distributions we can look at. Accuracy, bias, dispersion, and so on. And those are fine. Again, it's not a motivation for studying, but I have to think that this is part of what we've been doing. And there's a lot of correlations we can calculate with analyst forecast data. But again, this is not the real reason we should be studying this. And I think a lot of those reasons are part of the consternation about this literature, because people suspect we study analysts because we have data on them. The real reason is because we are interested as accountants in the information flows in the capital markets and how the markets operate. And it's a pretty easy story to make that analysts are a major player in our capital markets. And so as the literature evolved, we elevated analysts to an interesting economic agent to examine in and of themselves. Okay? And so I'll give you a framework on how I view this in a second. And so once we've elevated analysts to be an interesting economic agent, we start studying not just their forecasts and the properties of those forecasts, but their behavior and their decision process and their incentives and how they presumably use accounting information and communicate it. Okay? And so here's my simplified schematic of how I view the analyst job function. First, there is you've got to decide to cover a particular firm to get in the game. Once an analyst decides to cover a firm, they have a wide array of information at their disposal. Okay? Past prices in aggregate and for the firm itself. There's tons of information in financial statements. Managers provide the analysts with tons of information. Of course, we have suppliers and customers and site visits. And with that information, the analysts do something. Okay? And this is presumably the task that we're most interested in terms of analysts being a puller and pusher of information in the capital markets. And so, a hypothesis is that what analysts do is they assess the strategy of a company, look at the accounting numbers, see if they reflect economics. If not, they make adjustments, do some ratios and assess trends, forecasts for the future, come up with a valuation, and draw some conclusion about this particular stock. Once they've analyzed the company, there's formal and informal communication. And what we're most familiar with are the formal side with the analyst reports, where a lot of our data come from. And more recently, a lot of our data come from morning calls and morning broker notes. And there, another thing that analysts do, and I put it under formal communication, but I don't think we have appreciated it enough, but analysts often are required to make a minimum number of marketing trips where they go meet with significant clients. And presumably this analysis they do is a big factor in the presentations they do at these marketing trips. But there's also a bunch of informal communication within the brokerage to their clients and their brokers themselves. There's communications with the press and so on. So after the communication of the analyst's analysis, there's usually a way where we can settle up ex post and see how their analysis or how good it was. Okay? And for us, that's most often done by calculating forecast errors. Underlying this whole process, the analyst there's a bunch of qualitative factors, like the analyst's ability, their incentives, and a potential problem for us, and I say potential, is that we are most interested in the analysis, but we don't get to look at the analysis, right? So it's actually a black box. So instead, what we look at are certain quantitative outputs from the analysts, which most often have been forecasts. And we do correlations and regressions linking forecasts to prices and prices to forecasts. We also get financial statement numbers and see if how those correlate with the outputs. And recently, we've been looking at some of these qualitative factors like analyst ability and incentives and how they correlate with the forecast. And this is not exactly right, this line here, because often properties of the forecast are how we define ability. But the main point is we use inputs and outputs to draw conclusions about behavior. And I said it's a potential problem, but not necessarily, because my first reaction was, so what? When I put this slide together, I was arguing with myself and said, so what? This is what we do. We correlate variables to make as-if statements about behavior or about relationships between variables. And I think that's fine. But what I've seen in the literature, my sense, is that we've sort of gone past the bounds of saying, forecasts don't seem to impound information in fill-in-the-blank variable, to analysts don't pay attention to this variable. Now that's sort of gone beyond what we can do with this input-output analysis. So this is a incomplete timeline, and let me give sort of a shell of how I think the research falls. And I'm not going to mention a lot of papers, but the research seemed to start on analyst analysis officially, I would say, in 1968, coincidentally. I think there was research on analysts going on well beyond this. I believe Charles Horngren's dissertation was actually on analysts, but let's assume 68 is a good starting point. And there were several papers looking at analysts versus time series models. Excuse me, analyst forecasts versus time series forecasts. And this research went on for a good amount of time, and we had conflicting results. Analysts are no better than time series models. The first two papers, Bearfield and Comiskey, said analysts are better than a no-change forecast model. Brown-Rezef said the time series models are just about as good, but actually time series models may have an edge at longer-term forecasts, and I think that's important. Fried and Gavoli, looked at these prior papers and finally did a 11-year panel series of 100 firms each year, which was a huge sample size at this point in time. You got to keep in mind these early papers generally looked at sample sizes of 50 firms within 1 year, and this is how we drew conclusions. 5 years later, in '87, Brown et al. Concluded, yes, analysts are better than time series models, and it's due to two things: a timing advantage, which makes sense, and an information advantage, which also makes sense. So when you look at the first bit of research on analysts, it was 20 years for us to conclude, okay, analysts are better than time series models. Okay? And after that, or concurrent with that, researchers were also examining, okay, so we've got these expectations from time series models and analysts, which ones are better correlated with prices? Okay, and so there was a lot of price association studies going on simultaneously. Philbrook and Ricks actually looked at some combination of forecasts and actual earnings to conclude which one was the best proxy for market expectations, because back then our use of this data was because it was an input to more interesting research on valuation and value relevance of accounting information. Okay? Refinements and extensions to the literature started after that. The last forecast more accurate than the consensus. Analysts don't seem to differentiate themselves from each other. Well, actually, the institutional investors are more accurate. You drop the old forecast from a consensus, it gets better. Some analysts are better, but you have to have careful controls for that timing advantage that they have. Okay? So, and also analysts get better with experience, and analysts are better depending on the complexity of their reporting environment. So this whole literature, I'm going to group into one bucket. And the bucket is they focused on forecasts. And we moved from are analysts better than models to are some analysts better than other analysts. Okay? But again, the focus was on the forecast, presumably because all of this research was a underpinning of capital markets research on pricing, which we were presumably most interested in. What happened next was we started looking at analysts as an economic agent and how do they actually process information. So there's a lot of work on, do analysts understand implications of prior earnings changes for the future, price changes for the future, post-earnings announcement drift, do they understand that? Their own forecast errors, do they learn? Conditioning on the prior information or prior sign of earnings information or the prior sign of earnings components. And recently, there's a small number of studies that have moved away from earnings forecasts to recommendations to see how analysts use information in that decision. Okay, and I think a lot of these papers are motivated by Schipper's 91 commentary where she said, earnings forecasts aren't the in thing that an analyst does, but it's an input into some conclusion. Okay? So that's another group of literature. And I think this is where most of the research has taken place. If you see an analyst person coming to speak at your university, odds are they're going to say, I'm going to see if analyst forecasts understand information in fill in the blank. Okay? And recently, we've moved even further away from looking at the data, the forecast properties, to the economic agent, the analysts themselves. Right? So what are their incentives? Do they self-select out of giving bad news? Are they swayed by investment banking incentives? Is their turnover correlated with accuracy or optimism? And more recently, there's a lot of work on analyst loss functions, trying to figure out what they do. Okay, so this literature is, to me, the third bucket. So what we have are the evolution of the literature has moved from looking at forecasts to examining efficiency of forecasts, and now we're at the point where we're using the same data to make comments on analyst decision processes. Okay? And so one of the things I'll say is we might be pushing the envelope here on how much we can learn about these actual decision processes by correlating inputs and outputs. Okay? And so as I said, I've got 10 observations that I'll make. So that's less than 3 minutes per observation. Analyst forecasts are optimistic. If this is a statement, if you ask a random sample of academics, is this true or false? The bulk of people would say this is true. Okay? The question is, what forecasts are optimistic? Are they quarterly forecasts, annual forecasts of earnings, sales forecasts, growth forecasts? And what horizon are we talking about? Because I think the real answer, if somebody asks you, is not true or false, it's, well, it depends. And in addition, we have to keep in mind that the way we draw conclusions about analyst optimism, it's restricted to the data that we get to look at. And so Pat has several papers where she shows us that the properties of the data are a function of the data we get to see. The data is truncated. And furthermore, Jeff made this point a little bit yesterday. Conclusions about analyst optimism are based on forecast errors, which necessarily have to have an actual earnings forecast to pair up with the forecast. And as we've seen recently, some of the work on street earnings and such, the definition of actual earnings matters in how you determine whether an analyst is optimistic or not. And something seems to be overlooked, it's in a paper that I have with Richard, and Roby and Jeff have a paper showing something happened in 1992. The data we used got cleaned up somehow. So conclusions about analyst optimism are affected by the data, and and there are often extremes in the tails. And Jeff and Roby have the paper in JEE. Like a lot of people, my initial reaction to that paper was, they're telling me to trim the tails before I do any analysis. And it took me, you have to read it about 11 times before you realize that's not exactly what they're calling for. And you have to spend 3 hours talking to Jeff to understand the tail asymmetry. And he's promised to explain the middle asymmetry to me in the future. But this actually calls into question this primary conclusion about optimism. Jeff and Roby have a pithy comment in their paper where they say, after 4 decades, it's sort of, I'm paraphrasing, it's sort of disgusting that the one comment everybody seems to agree on is the one based on the least tenuous empirical support. Okay, so first observation is, are analysts optimistic? Well, it depends, but we really don't know. Analysts are better than time series models. Again, horizon is important. Right? Most of the literature concluding early on that analysts are better than time series models are based on near-term forecasts, quarterly or annual forecasts. The Brown and Rosef finding that I found most interesting is they said it's actually the longer-term forecast that if there's an advantage to the time series models or analysts, tilts towards time series models. Now, if we want to understand forecasts to use in capital markets research on valuation and value relevance of accounting, it's actually those long-term forecasts that matter the most. Okay, and so if I were to think about this literature, it might be worth looking again at whether this is a valid statement. A lot of that old research where we dismissed time series models said, well, there might be an absolute forecast error for an analyst of 16%, which is better than the time series model's forecast error of 19%. And is that significantly different? In the statistical sense, yes. Economically, I don't know. And something interesting is every other literature, particularly in economics literature, concludes the exact opposite with respect to the expert forecasts they look at. So the economics literature says no particular forecasters outperform time series models on a consistent basis. And why might that be? Well, obviously, the difference between forecasting GDP or interest rates and earnings is that with earnings, it's sort of an endogenous process between the analyst and the manager. Okay, and so analysts may or may not be better than time series models is, I guess, a revised conclusion from literature that I would draw. Now, Peter asked me to answer 2 questions. Even though I changed the title of my topic to analysts, I'll actually address the first one. We think we know how analysts forecast, but again, all of our data or all of our conclusions are based on correlations between public information and forecast errors to draw conclusions about how analysts forecast, more specifically, what information they use. And so these are the typical things we've looked at, and we assume analysts use or partially use past price changes, past earnings changes, their own forecast errors, management forecasts, various financial statement information. This whole wealth of individual items are supposedly used or incompletely used by an analyst to come up with a forecast. Okay, and Jeff touched on pedagogy yesterday, and so I thought, I might as well. But do we really believe analysts forecast earnings the way we teach our students to forecast earnings? Now, I don't know how everybody teaches, but most people, I think, have students build up a top-line forecast, look at working capital requirements and CapEx, extrapolate expense line items, and get down to a bottom line. But that's in conflict with what we do in this literature, where we say analysts must do that, but they also must look at past price changes to get implications about current forecasts, past earnings changes. And so there's sort of a disconnect between what we teach and what we actually expect from analysts in the research. And I think this gets at some of the stuff Jeff was saying yesterday. I don't want to spend too much time on this, even though this is the bulk of the research on analyst forecasts, which is looking at, well, are analysts inefficient with their use of information? It's similar to thinking about how analysts forecast, but a lot of this literature is based, again, on inputs and outputs. And let's assume, for example, that there's, the analyst variable is a forecast, and there's some variable of interest we care about, like past price changes. If those were perfectly correlated, right? If a true forecast was perfectly correlated with past price changes, when we use messy data, we're going to get the conclusion that analysts don't fully incorporate information in past price changes just because of noise. Okay, and so anytime you read a paper on whether analysts are efficient with using some information, it's 99% of the time you seem to get the conclusion, well, they seem to use it a little bit, but not fully. Well, and the bigger problem, besides this mechanical statistical problem, is back to the data issues that form the basis of concluding analysts are optimistic, because it's two sides of the same coin. And so the views that we have as academics that analyst forecasts are efficient, they may be, but that it's a stretch to say that analysts themselves don't understand or are naive about information. There's limited evidence on what analysts actually do with forecasts. Okay, and so I guess one of the first papers was by Francis and Philbrook. They looked at conditional on a timeliness ranking issued by Value Line that the analyst has no control over. If that's negative or bad, the analyst will trade off accuracy for optimism in the forecast. And so this is sort of one thing analysts do with the forecast they come up with. Banjo, Pottier, Brown, and Richardson found changes in earnings forecasts that analysts make explain 30 to 60% of the variation in changes in their target price forecasts. Okay, and so that tells me it seems analysts do use their earnings forecasts in coming up with that end conclusion about whether to buy or sell a stock, and that, as an accountant, that's actually comforting. Lowe and Meehan in a JFE paper recently find that analysts that are more accurate at forecasting make better recommendations. So there's two papers that suggest they use earnings forecasts to draw conclusions, but we don't really know how. There are a couple papers that look at how analysts come up with their valuations, and it seems they use a lot of multiples-based valuations. Okay, and this, casual observation, seems to confirm this, but rather than using these complex valuation models that Xiaojun was talking about yesterday, analysts seem to use these heuristic models, and survey evidence and interviews and observation studies all confirm this. That not only is it the case that analysts report with these multiples or heuristics, that actually when you ask them or observe them, this is actually what they do. There's some very interesting work, I think, recently. Barker has a paper in the European Accounting Review, and Asquith, McHale, and I have a new paper in JFE that shows analysts actually use a lot more qualitative information in coming up with their conclusions than they do just to focus on earnings forecasts. And I think that's important because if you look at the literature, we have focused almost exclusively on analyst forecasts, ignoring a lot of this other information that analysts use. Okay, and so sort of related to that, what we do in the research, again, is focus on earnings forecasts at the exclusion of a lot of other things. And analysts provide numerous quantitative data points. If we want to stick in the world where we use quantitative inputs and outputs that we can assess distributions and correlate numbers, well, there's tons of other things that analysts do. Recommendations are sort of the second most popular thing we look at. Growth projection, target prices. I know Stan has a recent paper on analyst risk ratings. The work on the prior slide is one step towards using a greater fraction of the analyst's outputs. And I just did a quick search to see how frequent it is that we use multiple data points from analysts. And earnings, recommendations, growth forecasts, and target prices are declining in importance in our academic literature. And when you start looking at combinations, it quickly diminishes. And I'm not saying we should be looking at more analysts' output variables just so we can increase the number of columns in our tables or increase the number of right-hand side variables in our regressions. But conditional on us sticking with the paradigm of looking at inputs and outputs to figure out how analysts behave and how they process information, conditional on sticking in that paradigm, it seems important to at least look at the internal consistency of analysts' own outputs, their forecasts, growth projections, and recommendations. That gets us a little closer to being able to say something about the behavior of analysts, albeit indirectly. Okay? One of the good things about analyst forecasts research and all that research that's been done over the past 3 or 4 decades is we have a pretty good notion that analysts' expectations are a good proxy for the market's expectations. And so if that's true, oftentimes when there are anomalies identified in the capital markets literature, we can move into the analyst forecast world or the analyst decision process world to see, do those anomalies that are supposedly driven by erroneous expectations, do they show up when we look at analyst behavior as well? And almost uniformly, when people have looked at post-earnings announcement drift, public offerings, value glamour splits, and accruals anomalies, when you look at the analyst behavior, the story that comes out of analysts behaving or misinterpreting information in the same way investors do seems to look similar. And when you do that, the critics of the initial anomaly, who often will argue that it's mispricing versus incorrect expectations, it's harder to say that mispricing is the explanation for the analyst data. Okay? So, for example, in the accruals literature, Russ Lundholm talks about the recent burgeoning Sloan is an idiot literature that's largely saying that the accruals anomaly might be due to some risk factor. Well, if you look after high and low accruals at analyst forecast over the next 12 months, if analyst expectations are like the markets, they'd be overly optimistic for the high forecast error firms, which is what we see on this bottom line, but they eventually get it right by the end of the year. And so this helps dispel one argument against anomalies, if that's what you want to do. Number 8, there's a conclusion. If you asked a random sample of academics, are analysts dominated by conflicts of interest? You get a predominantly set of responses that are true. And so these presumably come from investment banking ties and the pressure that the investment banking operation puts on the analysts to generate fees from investment banking because the research hasn't been a revenue source. Francis and Philbrick used the curry favor with management argument. For a long time, analysts needed information. And if managers have it, analysts will be optimistic or will affect their reporting and affect their analysis in order to maintain access with managers. Okay? And recently, Paul Healy has a paper where he shows that when you look at the accuracy or optimism or error in analyst forecasts among the big banks that had to pay the $1.4 billion fine that have investment banking and the small banks that generally have trading but no investment banking. The errors are greater for the small banks with the trading, and that's consistent with that being, the trade incentives being an incentive to affect analyst outputs. However, working against all this is the analyst reputation effect. Okay, and so this is sort of something that's always astonished me about this literature. When you look at prior results on affiliation effects, they're quite mixed. But our conclusions as academics are often, analysts are conflicted. And definitely in the popular press they believe that, selectively finding research that shows it. Now, Dugar and Nathan and Hansen and Sarin find exactly opposite results. But if we look at Lynn and McNuckles, which I think is one of the most comprehensive studies, and they have a nice match pair design, they don't find any difference between affiliated analysts and unaffiliated analysts in terms of their forecast accuracy. Okay? But on longer-term growth forecasts, there is a significant difference, but it's only 0.6%. Okay, and the recommendation difference is about 0.358. So there's clearly an affiliated analyst effect, but it seems that the real effect on optimism, or observed optimism by analysts, it's the firm. And so this is a recent paper with Scott and Richard where we look, here's the time of an SEO or an IPO, and we track recommendations and target price forecast errors around that. And what you see is the dark line are affiliated analysts, the dotted line are unaffiliated analysts. You see the little effect of being affiliated has on the optimism of the analysts, but even the unaffiliated analysts sort of track the same level. And so the major effect on optimism is not necessarily affiliation, in my opinion, but the actual firm itself. Now here's an extremely controversial thing I'll say. We may be focusing on the least important activities. Okay, so again, if I want to be cynical, I'll say accountants like measurement, and it's easy to measure things like earnings forecasts, forecast revisions, forecast errors, correlations with prices and forecasts. But measurement's not so easy for other things that seem to be important that an analyst does. For example, analyzing strategy, assessing the quality of management, providing management access. This recent paper by Barker in the European Accounting Review has really nice evidence that both buy-side and sell-side analysts, as a number one factor in determining whether they recommend or buy or sell the stock, it's assessing the quality of management. Okay, and that quality of management issue is sort of a variable that affects their assessment of terminal value. Okay, so one way you want to look at what analysts think is important. So I said, analysts, we may be focusing on one of the least important activities, which is earnings forecast, is look at one of the rankings of the primary users, institutional investors, of analyst reports and analyst data. What do they want from analysts? And if we assume analysts respond to what their major clientele wants to get an institutional investor ranking, for example, we'll see sort of the relative picture of earnings forecast for analysts. And what you see is, over the past 8 years, we've got all these things that institutional investors want from analysts. Stock selection and earnings estimates don't appear to be at the top of the list. So I felt the need for some kind of rigor in this presentation, so I converted the ranks to 0-1 span and then calculated t-statistics on were any of these changes significant. And I'm not going to submit this for publication, so I don't need to hear about all the errors or the problems in the way I've done this, but the biggest decreases over the past 8 years of things that institutional investors value from analysts are their earnings forecasts and their stock recommendations. Okay, and so that doesn't mean we should just put away analyst forecast variables as a subject of analyst research because they're still on the list, right? They still matter, but it may be that analysts forecast earnings for completeness rather than spending or being motivated to spend enormous effort on incorporating information in prior price changes, prior earnings changes, their prior forecast errors, and so on. Okay? So the final point that I'll make is as researchers, we tend to not like methodologies other than regression analysis of forecast error on information variables, for example. And I found there's an old paper that I kind of like by Larker and Lessig. I like it mainly because I think Dave doesn't like talking about his experimental research. But this paper makes a very nice point. They had an experiment where they had a number of subjects, and they gave them a buy, they asked them to make a buy, no buy recommendation. And they gave them 6 or 7 information cues like recent price changes, PE ratios, and things like earnings variables and so on. And this was a methodological study where they were trying to figure out, can we use linear models or do we have to use retrospective process tracing, which is essentially protocol analysis where you ask somebody to perform a task and then ask them after the fact, what were you thinking when you did this? So they wanted to see which of those models were okay at predicting what a subject would, what decision they would make. So in our world, it would be an analyst making a recommendation, what recommendation they might make, and also, is it which model is better at identifying which cues? Is PE ratio the most important thing in making a buy-sell recommendation? They wanted to see which method we need to use, and so what they found was both of these methods, doing regression analysis, linear models, and interviewing subjects, were able to predict pretty accurately the other, if they forecast 40, or they made decisions on 45 stocks, they split it in half somehow. Look at 22 decisions, you could predict the other 23. And the problem was the measures of what was important in that decision often diverged between these two methods. And so the simple point they made is if our research goal is to predict the judgment or the decision that somebody like an analyst is going to make, you can use the easy linear model or you can use this complex and costly protocol analysis. But given the costliness of the protocol, it's probably okay just to use the linear models. And that's what we do today. If the research goal is understanding what information is used, and this was sort of the flavor of the questions Peter assigned me, what information is used and how it's used, well, they conclude that some other methodologies, perhaps tracing procedures or protocol analysis, seem to be required in order for us to draw conclusions about the decision process itself. Okay? So they advocate multi-method research strategies. So archival strategies or methodologies that go beyond simple regressions of some output variable and an input variable. And these might include surveys and interviews, protocol analysis, transcript analysis, and experiments. I'm not advocating that we should all put away our IBIS tapes and start going out with our clipboards and interviewing analysts, because I don't think I want to do that. Well, actually, I've done a content analysis and learned an immense amount from it. All I'm saying is we seem to ignore those papers. There are a lot of these papers in the literature that can be used to collaborate with the standard archival methods to use the bulk of the evidence to figure out what analysts actually do. And a lot of these studies are listed in Catherine's 91 review paper, and there are a lot of them since then, but most people don't cite those. And probably because we know the criticisms of surveys and interviews and observation that small sample sizes, they're not rigorous, and then you get the common, well, that's just descriptive phenomenon, okay? And these other methods are costly, messy, or simply new. And let me give you an example. Boy, I wish when I was on the job market somebody used my paper as an example of things they like. But Mayu, who just graduated Texas and took a job at Duke, had a nice nice paper where you use a non-traditional methodology of looking at conference call transcripts to test the hypothesis of even post-FD, are more optimistic analysts more likely to be called on first in the question and answer session of a conference call, and do they get more airtime? And so it's an interesting approach to looking at a question that's of interest to all of us. But I know that the criticisms about small sample size, non-rigor, and descriptive evidence is probably going to apply to him as he goes through the process. So let me make a conclusion first that we actually have learned a lot in this literature. My 10 observations are primarily critical, but it's sort of like when Jeff said yesterday that Vic Bernard and Jake Thomas couldn't have gotten to the place of looking at post-earnings announcement drift without that 10 or 20 years of analysis that came in between. Now, all the analysis that we've had on forecasts to understand the distributions and then correlations with forecasts and various information variables, this is extremely informative, and I don't mean to denigrate that research as been useless. But there are some reasons that might explain why the academics in general seem to hold this research area in greatest disdain, is that we focus on a narrow set of analyst outputs, primarily forecasts, to draw conclusions about what analysts do and, more importantly, how they do it and how well they do it. The focus of the research has mostly been restricted to the variables that can easily be quantified. We generally look at a single variable in isolation rather than the multitasking world that the analyst operates in. And we've been focusing on what may be a low importance activity to an analyst to draw conclusions about how well that analyst understands accounting and other information. Studies that actually have tried to penetrate the black box through alternative methodologies seem to be overlooked. For example, the Larker paper, if you go on Google Scholar, it's been cited by 2 other papers, and I don't bring it up to make fun of Larker for writing a paper with 2 sites, but it's an example of that alternative methodology seems to be overlooked in our analyst research. This is an actually interesting time, obviously, for this literature. I mean, the recent settlement and new regulations that came in place to monitor analysts provide interesting shock to the system. And there's the recent independent research requirement has sprouted up a whole different set of analysts. And there's a trend now towards paying for coverage that makes this function in the capital markets extremely intriguing. It'll be interesting how it plays out. I know, for example, Lehman just signed a contract with Fidelity. This is about as big a contract as you can get for pay for research for $7 million. And, I've got nice clothes, but $7 million doesn't seem like a lot of money to me. Right? And so it'll be interesting to see how this all works out. So here's my last slide. In '93, Mark Smijewski commented on Larry's paper on analyst forecasts, and this was 13 years ago, and he said, researching the same old issues using the same old methodologies is probably not going to be informative. It's unlikely another study, and I filled in correlating forecast errors with some fill-in-the-blank variable will provide insights. It's naturally going to be more challenging to come up with interesting questions and different ways to look at them. Okay, so I am 5 minutes over, but I think we started 5 minutes late. So thank you very much.
Thank you, Mark.